All right. How y'all doing? My name is Randolph Love III. I do go by Randman on Facebook. It's always good to come out to these things and meet everybody in person. Like I said, I meet everybody electronically first, and then when I meet you in person, it's cool. I met Todd Stern electronically first. He actually worked on one of my first commercial claims, and I'm pretty sure he scratched his head a couple times, right? But, it's all about learning, right? And you come to these things, you might not learn a whole lot, but you usually learn at least one new thing that helps you win, all right? So whenever I'm in a room with at least 5 attorneys, I make sure to put my disclaimers up front, right? So, it's just, examples, right, to let you know how this works. Anybody ever heard of, infinity banks? Anything like that? Like using tax vehicles in order to grow your money tax-free, utilize it tax-free, and have it, when you die, it blossoms and pass to your heirs tax-free. I think a lot of people have heard of these things, but usually when people try to explain it to you, you leave confused. And I think most of the time, the reason that you are confused is because they themselves don't know how it works. So it's better for them to make you think you don't know what you are hearing than for them to know that they don't know what they're talking about. So my goal is to make sure that at least you understand how this works so you can make a knowledgeable decision of whether or not that you want to do it as well, okay? So it's max-funded index universal life policies. The wealthiest families in the world have their money in life products. The banks have majority of their money in life products. They have more money in life insurance than they have actual assets, right? Why are they doing this? I'm going to explain it to you. All right, so max-funded index universal life policy, tax-free. Is there anybody in this room that believes that taxes are going to be lower in the future? Why y'all laughing? It's a real question, right? I don't think y'all think that, right? Has anybody ever had a financial advisor say, hey, we're structuring this and preparing because when you retire, your taxes are going to be lower in the future? Have y'all ever heard that? All right? They're telling you one of two things. Either one, they believe that taxes will be lower in the future, and y'all just laughed when I mentioned that. And another, they're saying that they believe that your nest egg is going to be so minuscule that there's no way that you're going to be paying more money in taxes, right? So will it be lower? Will it be the same, or will it be higher? I think we all agree higher, right? So how do we go about that? Most people have their savings in something like this, right? So you got savings, you got CDs, you got stocks, you have bonds, you have EFTs, mutual funds, and annuities, real estate. And then you also have the qualified retirement accounts. You have the IRAs, the 401ks, the 403bs, right? The thrift savings plans, the SEPs. A lot of you business owners probably have SEP IRAs, right? But look how it's treated when it comes to taxes. On this side of it, the savings and the stocks and all of that, the portfolio income, you have 20% taxable. On the qualified, you have, once you get to pulling it out, right, up to 40%. Okay? A lot of you are business owners with partners. If I were to tell you that you can get a partner right now where they do none of the work, and once you're finished working, and you go to utilize this money that you've built, that they get to take 40%, would y'all take that partnership? Or what if I said, not only do this partner, once you do all this working and build up this nest egg, that not only will they take up to 40% and more, but they have the right to change the agreement at any time in the future. Would you do that? Would you take that partnership? No, that's Uncle Sam, all right? What we want to do is get to a balanced approach. We want at least 40% of your nest egg, the money that you're growing, to be tax free, okay? So what's the value? What does having tax-free money do for your portfolio, right? So this is just $1 doubling 20 times. If a dollar doubles 20 times, it equals 1,048, whatever that number is, $1 million, $48,576. But what if you apply 25% taxes? That same dollar doubling turns to $72,570.64, down from 1 million. What if you apply 33% taxes? That same dollar doubling now just went to 27,000, right? These are real numbers. Out of 100 people, only 5 are going to retire independently wealthy. Only 5. You can look this up. These are real statistics. Everybody know it. The people who are preparing, what are they putting their money in? The 401ks, the SEPs, the 403bs, all of that stuff. They're a part of the 95% that don't get it most of the time, all right? So you want your money to be tax-free. What's another thing you want it to be? Protected from market losses. All right? You want your money to lock in and reset. You don't want to go to sleep thinking that you're going to wake up broke. You don't want to go to sleep. What's happened over the every 3 to 4 years? What happens to your money that's in the market? You get a correction, right? It drops 30 to 40%. That takes away all of the benefit of the compounding interest. So not only are you dealing with the taxes of it all, but now you're dealing with every 3 to 4 years, your money, your balance dropping 30 to 40%. You want to remove that, right? How to remove that? This is my man right here, Warren Buffett. Rules of investing. Number 1, don't lose money. What's number 2? Don't forget rule number 1. Warren Buffett says, I'm smart in spots. They say, people tell me I'm smart. No, I'm not smart. I'm smart in spots. I just stay around my spots. Before me becoming a public insurance adjuster, I was already a chartered financial consultant, right? Financial advisors, they are not allowed to tell you about taxes. And why are they going to tell you about the market volatility? Guess what? If they mention the tax implications to you, like officially, they'll get in trouble. They'll get fired. They're not allowed to do that. I am. I have the designations to do so. So I want to go ahead and just look at a 20-year stretch of the S&P 500, okay? So, and this is going from January 2000 to March 2020, okay? Yeah, you get a lot of upsides, but then you get the downsides in the market. The trick is to get rid of the downsides, all right? You want to get rid of them. A lot of people in this room, you're probably the first in your family to make over $100,000 a year. Maybe not all of you, but I know where I'm from. I am, right? Even if the monarchs of your family, your mother, your father, your grandfather, your grandmother, your favorite aunt, your favorite uncle, they can give you their best financial advice, and it still be the worst advice because they've never been there, right? So they're going to tell you to put your money into these things. Even the S&P, if you got your money straight in there, once again, every 3 to 4 years, you're going to deal with a correction. You want to get rid of that stuff. If you have $100,000 and the stock market drops 50%, where are you? Somebody help me out. I know I got some stock people. If you have $100,000 and it drops 50%, where are you at? $50,000, right? What happens if it goes up 50%? Where are you at? See, we got Caden, man. When the stock market drops 50%, you're at $50,000. And then it goes up 50%. What most financial advisors would tell you, all right, you just broke even. And if you don't know what you're looking at, you're going to, okay, well, I guess, it went down 50, it went up 50. But no, if your principal drops 50% and you're at 50,000, in order to get back to where you started to break even, it has to go up 100%, right? Up 50, down 50, up 50, down 50. Once again, what they're going to tell you is you're even. Hey, listen, this is a part of investing. This is a part of being an adult. You got to be able to deal with this, right? Now, let's look at it. just like we said, if it goes up 50%, you just made $150,000. It goes down 50%, now you're down to $75,000. It goes up 50%, now you're up to $112,500. It goes down 50%, $56,250. You thought you broke even when really and truly you're in the hole, right? At least $44,000. This is what you want to get to. Now, I like to underpromise and overdeliver. I think that's the best way to, run any business, right? Now, a lot of these indexing that these insurance companies use, and just so you know, there are insurance carriers that don't do property and casualty at all. All they do is life and annuities. So you don't have to feel any kind of ethical or moral implications, right? But that being said, just like Cal says all the time, these insurance companies are using your premiums to fight you. When I run across public adjusters who are doing, seemingly shysty things, right? It's because they need the money. What if you have this working for you and the money isn't a big deal to you? You want to just do what it takes to get the insured properly taken care of. Now you're using the insurance company money to fight them. Think about it, right? So a lot of these products, these vehicles, they have a cap of 11%. Now, there are uncapped, but let's just say if we're just at 11%. Let's use this as an example, okay? So one of my mentors says, what takes the time and learning? Not getting it, right? Let me hear y'all say it. What takes the time and learning? I want to make sure you get it today. Just basic. How do you determine if a index is going up and down, and what's the percentage? You take the end date value minus the beginning date value, and that equals the difference value. Then you take the difference in value and divide it by the beginning date, and that's the percentage change in the index. All right, so let's look at it. Now we're going to look at S&P 500, February 2019. It went down $2,779.83 from that's where it was at, and then February 20 is $3,370.29. So how do you figure that? You take the end date value, which is the $3,370.29, minus the beginning date, which is February of that the previous year, which is $2,779, and then you come up with a difference of $590.46, right? When you take that and you divide it, you get a difference of 25.9%. So if you put your money in the market in February 2019, and then February 2020 the following year, and you put it in the S&P 500, you would have gained 25.9%. That's a good gain, right? Great. If you had your money inside of a properly structured max-funded IUL, your cap would have just been 11%. And somebody might look at that and say, wait a minute, I just missed out on 25.9 in order to get a cap of 11%. Okay, that's one way to look at it. But let's look at March. Because the way this works is when you put money into the index in a month, that's what you tie your money to. And then the following month, that's when it pays out, right? When you're dealing with these index universal life policies, right? So let's look at March 2019. And I think it was March 2020 when I attended the boot camp, I believe, right? Right, so let's look at March 2019. Let's say you put your money in March 2019, it would have been $2,808.48. And then March the following year, it was $2,386.83. That's a difference of a negative $429.65, right? If you had your money in the market, you would have lost 15%. So you went up 25%, and then you just lost 15%, right? If you had that same money inside of a properly structured, max-funded, index universal life policy, you would have lost zero. Zero is your hero. When you have that cap of 11 and you have that floor of 0, now you get all the benefits of the gain at that 11, and then you don't lose anything. Now, what does somebody do if they have their money in a properly structured, match-funded, index universal life policy, and they see the market just take a plunge like that? That's when you utilize a strategy to shift your money into one of the uncapped indexes. What does uncapped mean? That means you get the benefit from all this. Because what happens is, when you lose that 15%, what did we just say about losing 50% and then going up 50? When you lose 15%, you got to get 30% just to get back to where you started. When you have your money in a properly structured index universal life policy, once that year is over, that's your new floor. That's your new basis. It's going to take them at least 30%, the people who have their money put directly in the indexes, to just break even. Whereas if you have your money in a properly structured index universal life policy, you're going to start making money the very next year. The very next year, because that's your new base. Okay? So, once again, doing the same thing. February 20 to February 2021. A difference of $556.54. If you had your money directly in the market, you just made 24.76. Once again, we still dealing with this cap if you have your money in a properly structured index universal life policy. But let's look at March. A change of 64%. Because what we're going to do, because what do we do if you had your money in a properly structured index universal life policy and you were dealing with, it doesn't have to be me, but anybody who knows what they're doing, they would have shifted you over, and now you would have got all of that gain, right? To whereas you're still worrying about trying to catch up if it was just in the indexes, all right? What's the point of gaining money, accumulating it, if you can't access it? That's the most important thing. When you're looking at money growing, there is a tier. What's the most important thing about any vehicle that you use to grow money? Does anybody have an idea? Is it the rate of return? What is it? What would you say it is? What's that? Accessibility. Anybody not agree with him? Accessibility. I agree. Number one, you want it to be liquid. That's the first thing. What's the point of having money? What's the point of it growing if you can't get to it? Number two, you want it to be safe. What's the point of having money that you can get to, but every time you go to sleep, you have no idea what it's going to be worth tomorrow? Number three, you want it to have predictable rates of return. Yeah, it can be liquid. It can be safe. That's like a savings account, but you're only earning 1%, less than 1% a year in a typical savings account. And then you got to pay taxes on that, right? So you want it to be liquid first. You want it to be safe second. Number three, you want it to have predictable rates of return. And then you want it to be tax favored. What's the point of having money that you can get to? What's the point of having money that's safe? What's the point of having money that has predictable rates of return where as soon as you try to access it, they're hitting you up for 40, 50% of your money? That's not the American way to me. A lot of people will say that they believe that paying taxes is their civic duty. And I'm not going to say anything against that. I just want to ask one question. Do you believe that the government is handling your tax dollars properly? If you had the potential, the possibility of taking that same money that you would have spent in taxes to spend on your favorite charities, to spend on your favorite people, to spend on your favorite things, would you not take that route? When you set something up like this, you can still do your civic duty to help your fellow man, but it can be in your hands to do it because you properly put your money in, okay? All right, so a lot of these things that I'm talking about, it might be neck and neck to some of your other things, especially if you have like a Roth IRA or a Roth 401k, because what you're doing is you're paying taxes on the seed and not the crop, right? But where a properly structured match-funded index universal life policy really starts to show out is when you start accessing the money, okay? So let's look at this. So just so you know, when you're dealing with a life policy, you have what you call accumulated value and then you have a cash value, also known as a surrender value. Your money, that percentage that I was telling you, growing with a cap of 11%, that money that's growing in there is coming off the accumulated value, not your surrender value. So what do I mean by that? All right, so look at this. Let's say you have accumulated $1 million into your cash value of a properly structured, match-funded, index universal life policy. And it's growing on average of about 10%. Because what happens is when you get a return of 11%, the cost of insurance is approximately 1%. So that leaves you with a real return of 10%. So let's say you have $1 million. So it grows 10%. So now you have $1,100,000 in your policy. And then you borrow out $100,000. Now, I'm in a room full of entrepreneurs, so I don't think y'all is scared of borrowing as a lot of consumers are. But let me tell you how borrowing works when you're dealing with a properly structured index universal life policy. On your tax return, you have portfolio income, earned income, and passive income. Nowhere on the front of your tax return do you see borrowed income, right? So you want to borrow from this. The reason why I like index universal life policies instead of a typical whole life policy, well, first and foremost, the name says it all. Typically, when you set these up, you're paying into it for your whole life, right? I'm not trying to be doing that for my whole life, right? But when you borrow from a typical whole life policy, they're going to charge you an interest rate. And once again, you want that interest rate because you want it to be considered borrowed money. But when you borrow from a typical whole life policy, they're going to charge you an interest rate. You do not have to pay that money back during your lifetime. You do not have to pay the interest back during your lifetime, but it is going to come off when you die off the death benefit. When you borrow from a properly structured, match-funded index universal life policy, they're still going to charge you that interest rate, approximately anywhere from 4 to 5%, right? But as soon as they charge you that interest rate, they're going to automatically credit you the same amount. Y'all heard me right. They'll charge you 4.5%, then credit you 4.5%, and then you can use that money to buy upside options. Does anybody know what upside options are? Upside options mean here, Mr. Broker, I'm going to give you this money so I can have the option. Let's say it's a share at $50 a share. They say, hey, I want to give you this money, this 4.5% that I didn't even have this money. The only reason that I have this 4.5% is because I borrowed money. I'm playing with the house's money. But I want you to take this 4.5% that I just got for free, and I want you to use it to buy upside options. And I want you to, let's say if it's $50 a share, I want you to use this money and give me the right to buy these shares at $50 a share, even if it goes up to $100 a share, even if it goes up to $150 a share, even if it goes up to $200, I want the right to buy this at $50, right? And of course, if the stock market does well, which it typically does well 7 years out of every 10 years, if you look at the history, usually out of every 10 years, the stock market does well 7 out of 10. So if it's one of the 7 years that it does well, I want to go ahead and exercise that right to buy that share that just went up at a lower amount. What happens if it's one of the 3 years out of the 10 that the stock market does bad? What happens? You just let the option expire. It wasn't your money anyway. That 4.5% that you used to buy upside options didn't even exist until you borrowed the money, right? So now who's winning? Who's losing? I think you're winning. All right. So let's get back to this. So you go and you borrow out $100,000. That's your policy loan. So now your cash value, because remember your accumulated value, all the money that you put in plus interest is $1,100,000. Your cash value, also known as your surrender value, since you just borrowed out $100,000, is now $1 million. Guess what's going to happen the following year? It's going to grow another 10% on average. And now you have an accumulated value of $1,210,000. And guess what that 10% is going to be accumulating off of? That $1,210,000, not that $1 million, right? And looking at that loan, so even if we take into account the loan, the percentage on the loan, now you just borrowed out $104,500, assuming that it's a 4.5% interest rate. Now your new cash value is $1,105,200. Forgive me, God. Anyway, $1,105,500, right? And once again, it's going to still keep accumulating off of this. All right. Anybody in here own real estate? Real estate. Yeah. I bought my first house when I was 22. I own a couple properties now. And once again, it's one of those things to where they call it passive income. We know it ain't that passive, right? You actually got to work for it, right? But imagine if the government were to come to you and say, hey, this 5-story property that you just bought, we only want you to lease out 1 floor a year. The first year, you can only lease out 1 floor. The second year, you can only lease out the first and the second floor. The third year, the first, second, and third, and so on and so forth, till you eventually have all 5 floors leased out. And they tell you, as long as you do that, because you already know you're going to lose money that first 5 years. A match-funded index universal life policy compared to the other vehicles is probably the most expensive in the first 5 years. Does anybody in here truly believe that they're not going to be around for at least another 6 years? Right? The attorney, it depends, right? The favorite response of attorney, it depends, right? It depends on what happens, right? But if you're somebody who truly believes that you're going to be around for longer than 5 years, right? Even if you don't, you help your family out, right? Give me some commission, right? But let's say you truly believe that you're going to be around for another more than 5 years. Why not take this deal? Because as long as you do it like that, all of the money afterwards, as long as it's properly structured, as long as you access it correctly, is going to be tax-free. How does that work? This is probably for the engineers in the room who want to, you don't go off stories, you go off of facts. You want to look up Internal Revenue Codes 101A, 72E, and 7702. Internal Revenue Code 101A says that as long as it's considered a life insurance policy, it's able to grow tax-free. 7702 says as long as you 72E says as long as it's considered a life insurance policy, you're able to tax assets, it grows tax-free. 7702 says as long as you borrow the money out, you can utilize it tax-free. And 101A says when you die, it blossoms and transfers to your heirs tax-free. And then you have TEFRA, DEFRA, and TAMRA. Anybody that has any life policies right now, I want you to call your life insurance agent, and the first thing out your mouth, I want you to say TEFRA, DEFRA, and TAMRA. Don't say nothing else. Just say TEFRA, DEFRA, and TAMRA. Most likely they're going to say, what is that, the cast of Moesha? No. No, if they don't know these internal revenue codes, if they don't know these tax equity and financial, I'm on stage, y'all. The lights are in my face, right? But if they don't know these TEFRA, DEFRA, and TAMRA, if they don't know those abbreviations, those acronyms, if they don't know the internal revenue codes, then it's only one or two things that's just happened. They either don't know or they didn't care to tell you, right? And yes, on stage in the light. Appreciate it, Scott. And once again, that's another person that I've known electronically for a long time. We just met for the first time here, right? So at the end of the acquisition phase, your match-funded insurance contract is usually about a fifth, which is 20%. The way this works, they call it the 7-pay rule, all right? So what happened was in 1980, E.F. Hutton, which is a brokerage firm, said, hold up, all these wealthy families are already using, because for over 100 years, wealthy families have been using life insurance to grow their wealth tax-free. But so what E.F. Hutton said, why don't we just go ahead and utilize this money and then put it into the indexes, right? Okay? So he said, all right, bring it on. When they first started doing this, you had people pulling out $500,000, $1 million at a time, and just getting $500,000, $1 million in life insurance. Because as soon as they called it life insurance, it grew tax-free. What happened to E.F. Hutton? The IRS came and sued them, and the IRS lost, right? So what they did when they came up with Tefra, Defra, and Tamra, they said, hey, we need to slow down the bleeding. You are able to still benefit all of these benefits from a properly structured life insurance policy as long as you don't put more into it than it costs to put into it in the first 11 years. If you have a whole life policy, it has to take at least 7 years for you to avoid it being called an investment. If you have a properly structured index universal life policy, it takes about 4 years and a day, 4 to 5 years, okay? If you have 1/5 of your apartment building rented out, the business owning apartment building would be profitable. Not yet. But filling the policy up to the maximum levels during the years 2 through 5 is like renting out the additional floors. When you do this, like I said, it's going to be probably the most expensive vehicle in the first 5 years, but after that, it's going to be the best. And if you treat it like an apartment building, if you think about it like that, all right, that's all you have to do. You just have to put money into it for 5 years, and once you max fund it, that's when you got your cash cow. All right? And it's just another way to do it. Now, what makes this different than like a SEP IRA or something like that, or a 401k or Roth 401k or something like that, not only can you access it before the age of 59 and a half, right? Not only can you do that, but also, you don't have no cap. Now, once I have a conversation with you, or anybody, whoever the person who helps you, whoever your lead advisor is, once they have a conversation with you, we're going to figure out what your goals are, and we're going to have to create a cap. Once the cap is created, that's when we come up with whatever the death benefit is. Now, if you want a life insurance policy just for the death benefit, then there's other ways that we can structure this. But if you want to utilize a life policy so that it's liquid, so that it's safe, so that it's growing at predictable rates of return, and that it's tax favored, the death benefit that's the last thing. That's just a byproduct. Because what happens is eventually the cash value outgrows whatever your initial death benefit was in the beginning. And just like that apartment building, it grows. And this right here, that little tree down at the bottom, that's the cost of insurance. Because you want to structure it in a sense to where it's still considered life insurance. Would you rather have a life policy and pay no taxes, or an investment and pay taxes? I'd rather have a life policy and pay no taxes. And when you structure it correctly, the cost of insurance will be approximately 1%. It doesn't matter how old you are. Even if you have bad health, when you structure policies like this, the insurance carrier sees you as a partner. They're going to make it work. But now let's say for whatever reason your health is so bad, or your age is whatever's going on to where you don't qualify for a life policy based off of yourself. Has anybody ever heard of a surrogate? Right? I think we might have a surrogate here, right? Right? Usually when people think of a surrogate, it's somebody carrying a baby for somebody else. However, when you're utilizing a policy for the cash value, for the life benefits, you do not have to be the insured. Imagine yourself and put a plus sign in front of you, all right? Imagine yourself and put a plus sign in front of you. You have an insurable interest in your children and in your grandchildren. You have an insurable interest in your parents and your grandparents, and you have an insurable interest in your brothers and your sisters. That means that if you're not insurable, but you still want to utilize this to grow money tax-free and access it tax-free and have it grow like that, you can put insurance on your child. You can put insurance on your parent. You can put insurance on your brother and sister. They can be the insured, and you would be the policy owner, which means you have access to all of the growth, all of the life benefits are your benefits. So even if you feel like that you can't qualify based off your own health, but you still want to utilize this vehicle, this miracle money vehicle, what I call it, you can still access it utilizing your family members, okay? So this is something that I like to mention to people, because as soon as I say this, somebody is going to think, well, oh, shoot, I got my cousin, I got my brother, I got my sister. They got a life policy. I'm just going to they got a life insurance license. I'm just going to reach out to them and have them put it together. Listen, Matt's funded a life insurance policy, a IUL, it's just a club. It's not a swing. I put a post online, just to see what people say, because even though I never played, I know it's hard. But I said, hey, outside looking in, golf looks easy. Everybody just started laughing, right? Because everybody knows it's not about the clubs. It's about the swing, right? You want to make sure that you're dealing with somebody who knows how to swing. Now, I have about 14 questions that you can ask somebody to make sure that they know how to swing. I'm going to have our contact information. You can reach out to me. I can let you know what those 14 questions are. And you can reach out to whoever your advisor is. And if they can answer those questions, hey, you might have a Phil Mickelson on your hands, right? But if not, they just got a bag full of expensive clubs, okay? So you want somebody also to have a process, a unique process, all right? Whenever you're using a GPS, what's the first information you got to put in to find out where you want to go? Your destination? Wrong. You got to put in where you're at first. When your GPS is trying to discover how to get you somewhere, the first piece of data that it's going to utilize is where you at. You want to make sure to know where you're at, right? So what I use is a chart, and reach out to me. I can send you this chart. It can help you find out exactly where you're at financially, and then help you get to where you're trying to go. You want to get from the 1s and the 3s and the 4s on up to the 9s and the 10s. It's very simple when you know what you're doing and when you're dealing with somebody who knows what they're doing, okay? Now, I just had my first baby in February. Appreciate it. Thank you. Her name is Infinity Unique Love. Her initials are IUL. All right, so this is what I'm doing. So somebody told me they got to see it to believe it. I believe it was Ricardo, right? He said they got to see it to believe it, right? So this is what I'm doing. This is the most recent Index Universal Life policy that I started. I put in $35,000 in February, and it has an accumulated value of $31,000 right now, approximately. Right? Now, if you look at it, when you look at your policies, you're going to see the surrender charge. Now, if any of you are thinking about ending one of your life policies, it's almost always better to borrow out everything that you can instead of just asking them to surrender it and give you the money surrender. The reason why is almost all the time you're able to borrow more out of your permanent policy than you are when you surrender it, okay? And like I already showed y'all, this money is going to be accumulating off of the $31,701. I have a little bit over $1 million death benefit. So if I put in $35,000 and I have an accumulated value of approximately $31,000, does that mean I just got $1 million of life insurance or about $4,000? That's not bad, right? This isn't a term policy. This is a permanent policy, okay? And if anybody wants to either get this slide or figure out what those questions are to ask your current advisor or request an appointment, please scan this. I want to thank you so much for giving me this time. Thank you for Kyle, Melanie, and Sean for putting this on. And I'm glad I'm here to learn with all of y'all. Thank you.
Thank you very much, Mr. Love.